Thank you for joining us for our results for the financial year ended June 30, 2020. Before we get started, I'd like to talk about our safety performance. We were deeply saddened by the death of one of our colleagues, Duncan Mankadi Nawatu, following an incident at the Ifilula Colliery at South Africa Energy Coal in May. We immediately responded with support to Duncan's family, friends and colleagues, and also undertook a detailed investigation. What we learned from this investigation has now been shared across our operations to help prevent a similar tragedy occurring again. Around the world, we continue to adjust to the different phases of the COVID-19 pandemic. Our response to COVID-19 is focused on keeping our people well, maintaining safe and reliable operations, supporting our communities through the pandemic, and protecting our strong financial position. Despite the tough conditions in commodity markets during the year, we delivered a strong operating result with annual production records at Australian Manganese Ore, Hillside Aluminium and Brazil Alumina. At Illawarra Metallurgical Coal, we successfully returned to a 3 longwall configuration in April. We have also completed our review to maximise value at the operation rather than volume. The plan will see Illawarra target approximately 7.6 million tonnes per annum at an all-in cost of $100 per tonne beyond FY20. Moving to our financial results, where a 20% reduction in the average realised prices for our key commodities was the main contributor to lower underlying EBITDA of $1.2 billion. We moved quickly to protect our strong financial position during the year. We recorded lower operating unit costs at 9 of our 10 operations, delivered $50 million in annual savings since FY18 across the group by simplifying our functional support structures, and reduced our capital spend. Sustaining capital expenditure was 17% below our original guidance for the year, with a further reduction planned in FY21 as we redesign and reprioritise our expenditure for the current environment. Free cash flow from operations, including distributions from our manganese business, was $583 million, as we also drew down inventory, resulting in higher sales volumes and increased cash flow. During the year, we also took the decision to suspend our on-market share buyback with $121 million remaining. While the program remains suspended as we navigate this unprecedented period, we have extended its execution window by 12 months to September 2021. This provides flexibility to restart as risks from the pandemic subside and as our financial performance improve. These proactive and decisive actions supported the delivery of year-end net cash balance of $298 million. Looking ahead to FY21, we expect to increase production volumes and lower operating unit costs across the majority of our operations. We are continuing to pursue further cost reductions and expect an additional $50 million in annualised savings from FY22 as we exit lower returning businesses and further simplify our functional structures and footprint. Our capital management framework is unchanged and a strong balance sheet remains central to our strategy. We continue to believe the combination of high operating leverage and undue financial leverage delivers a suboptimal outcome for shareholders. The strength of our financial position and disciplined approach to capital management supported $424 million in shareholder returns in respect of the year, including the board's resolution today for a $48 million fully franked final dividend. We continue to reshape and improve our portfolio during the year, investing in greenfield exploration, forming a joint venture with Trilogy Metals for the Ambler Metals project in Alaska, and progressing studies at multiple projects. At our Hermosa project in Arizona, we are continuing to unlock value at both the Taylor and Clark deposits, as well as the broader land package. At Taylor, we increased the size of our mineral resource estimate, with the pre-feasibility study due to be completed in the December 2020 quarter. we declared a first-time mineral resource estimate for the Clark deposit, and we've commenced a scoping study assessing potential options for an integrated development with Taylor and battery technology and market opportunities. We also increased the size of our land holding during the year, and we've identified 15 targets for investigation across the prospective regional land package. At Ambler in Alaska, we commenced a pre-feasibility study for the Arctic deposit, and back in Australia, the feasibility study at the Eagle Downs project remains on track with the final investment decision due by the end of the calendar year. We progressed our study work for the Dendrobium Next Domain project at Illawarra Metallurgical Coal ahead of an expected investment decision in the first half of next calendar year. Allocation of capital to each of these projects will face the same rigour and discipline we apply within our broader capital management framework. Each project must compete with other uses of excess capital and deliver value to our shareholders. On the other side of our portfolio, we progressed our exit from lower returning businesses. Our agreement to sell South Africa Energy Coal is on track for completion by the end of the calendar year, subject to meeting a number of material conditions. We placed our Metalloys manganese alloy smelter on care and maintenance, and subsequent to the year end, entered into a binding agreement to divest our Temco manganese alloy smelter. As we continue to navigate a period of potentially extended market volatility, we're focusing on sustainably improving our operating performance and reshaping our portfolio, underpinned by a strong balance sheet and capital discipline that together will create value for shareholders of South32.